All right. It is 2026. It is our first meetup of the year, 2026 Central Texas Market Outlook for Passive Investors. I'm excited to have Danny with us this evening. We just finished our breakout groups, and that's always important to me because networking, you can't record networking. It's like one of those things you got to do as much as you can. So excited for having the opportunity to have those conversations. And now we are ready to get started. For those who have just joined our meetup, we have about 16, almost 1,700 members within our meetup. Each month we'll have about 15 to 20 people join. And so it's nice, intimate, and you can learn quite a bit through the speakers and the discussions we have and just from people here. But we'll talk about the good, bad, and ugly of multifamily investing. This will be an example of San Antonio when there'll be good, bad, and ugly of San Antonio. And those are the type of things we talk about each month. But it's a place to network, build relationships. We do the breakouts from 7:05 to 7:15. So for those that are just joining or joining in the future, there's always networking in the very beginning. Then we go into guest presentations and Q&A. One of the things I love about the virtual meetup is you got people all over the country, and you just have those opportunities to connect and network. So a little bit about myself. We've got about 60 million assets under management, primarily in Texas. We just purchased with our partners. We got several partners on this call, two in San Antonio last year. We've got a multifamily hotel and retail development in Bryan that we're working through. But I would say 80% of our portfolio is multifamily in the Texas Triangle, and then have about 25% that does more development. So we've done a 20 by 50 storage development. We're doing a build to rent community. And then, as I mentioned, we're doing this mixed use development in Bryan. But our bread and butter is multifamily. It's what we're passionate about. It's what I've doubled down on when a lot of people have left multifamily. At the end of the day, people need a place to live. And I've seen these cycles through my 18 years of commercial real estate. So excited to be in this cycle right now, buying multifamily, especially when a lot of people are not. These are great times to buy. So excited about that. My team member Shelby, she's my right hand lady. She is our chief of staff at CREI Partners, but she's also heads the investor relations. So most of the people on the call that have been in our ecosystem have spoken to her, or at least a text or a call has been reached out. She loves building relationships and been with us a little over a year, and helping you through the system. Hospitality, white glove experience is what we really prioritize and hope for at CREI Partners. Got two more slides. This one here, this is free education. I have a lot of investors that joined, and I know a few of y'all just listening in. This is you're just learning about passive investing, which is amazing. You can do this monthly call, and it'll take you 12, 24 months to get all the information. And that works for a lot of people. That's great. But if you're wanting like a crash course, this is free. There's no sales pitch. There's nothing other than like I really wanted to put, 5 to 6 hours worth of content all in one place for you to join. It's free. PassiveInvestorCoaching.com. I just really like surrounding myself, especially in our deals, that know about the risk and what to ask for during investments. So take that as a tool that you could use. All right, so enough about CREI Partners and passive investor coaching. I want to introduce you to Danny. I've known Danny for several years. He is the expert with anything real estate with South and West Texas with CoStar. Like mentioned prior to the recording, Danny and I met a couple months every year. I really try to, as a subscribing member of CoStar, take advantage of their research department. It's by far the best of the best, and it's not cheap, but that's something that as a limited partner who are investing in our deals, like we need access to this great research. And so Danny is an incredible resource. He's based in San Antonio, and I know he's got a lot of content to provide us. And I know that he would love to, have questions and such. So feel free to put questions in the chat box. I will read them. Or when he says, you can definitely, ask questions throughout. So with that, I'm going to stop share and turn it over to Danny. Danny, thanks for joining us.
Happy to be here, y'all. Hopefully everybody can hear me just fine.
We hear you.
Great. Now let's make sure y'all can see my slides just fine. One moment. Okay. All right, how's it looking?
It is
Good.
looking good. Thank you.
So, appreciate the introduction, Wayne. I definitely don't deserve that much praise, but I appreciate it, and I appreciate you, reaching out and being an active subscriber. A lot of people are more interested just in the data and kind of looking at things, and other clients I think are more interested in asking why and you know, trying to get more qualitative information in some ways. And Wayne's definitely one of those people, and so I appreciate those kind of clients. To be honest with you, it makes things interesting for the job to be sure. And I like digging into the data with you guys, and I hope that you all enjoy today's presentation. So without further ado, I'll go ahead and launch into this presentation today about the San Antonio multifamily market. Like I said um, earlier to some of y'all in the breakout room that I was a part of, we're going to try to include more than just San Antonio in this presentation. That's going to be the main focal market here. It is my main focal market at CoStar. But there's going to be plenty of good information in there as well about other markets, especially Sunbelt markets that are quite similar at the moment, and they're all kind of experiencing much of the same thing in early 2026. So we'll go ahead and kick it off. So we'll start with the situation that's making all the headlines right now, right? And that is the vacancy situation. So for the apartment market locally, and this is what you're looking at, the local apartment market. Vacancies have risen quite a bit in San Antonio. As of right now, we're looking at vacancy rate just below 15%. That is well above where it has been historically. Historically hasn't gone much over 11%. You'll see the forecast, of course, is that it's going to probably be going down from here. But the question is, how did we get in this situation? Largely, it's due to supply, and I'll dive into that in future slides there. But this is something I think you got to lead with because this kind of sets the tone for the rest of the discussion and the presentation. We can talk about why the dynamic in the local market is what it is today, and why is it possibly going to change in the future. As you can see, by 2027, 2028, 2029, we're envisioning that the local vacancy rate will be a lot lower than what it is today, or at least notably lower. Maybe it won't go back to the situation it was in when San Antonio was a lower development market where it was about 9% vacant, but definitely probably down from here according to our base case forecast. And this is the same thing still at the local level for San Antonio, broken down by star rating. So star rating is quality types of apartments. So the local multifamily market can be dissected in a number of different ways. CoStar calls 1 and 2 star, or calls the lower segment 1 and 2 star, the middle segment 3 star, and then 4 and 5 stars kind of our higher end for the local apartment market. They roughly correspond with Class A, or excuse me, Class C, B, and A apartments respectively. But there's a little bit of nuance there because you can have some 4 stars that are Class C. Technically, it's about the quality of the product at the end of the day, and higher quality product generally correlates with 4 and 5 star, and that also generally correlates with newer apartments. So what's possibly going to be leading the local vacancy rate lower in the future is going to be that 4 and 5 star segment. And that's really the 4 star segment doing the heavy lifting there because there's just not a lot of 5 star apartments in many apartment markets, and San Antonio is one of them. So it's a lot of 4 star inventory that's been delivered. Some things that have kind of nicer amenities, and those complexes are probably going to be seeing most of the absorption, I would say, over the next few years, and that's going to bring the market-wide vacancy rate lower. Now, you'll notice the 3 star and 1 and 2 star may be stuck for a bit in kind of higher territory. To be honest, I think there's a little bit of extrapolation there, and if you were to ask me, I don't think that these trends will necessarily differ that much between all those cohorts. But looking into the future, if what's happening right now continues to happen into the medium term, there will probably be more downside risk there for the vacancy rate for that 3-star segment and that 1 and 2 star segment. Of course, I mean, there's room for debate there, and there's a variety of forecasts we produce, but that's our base case right now. By the way, I want to say, like, just because something is 4-star doesn't mean it's necessarily the nicest complex out there. There are plenty of what you may call average normal apartments that just happen to have nice new amenities that we would also classify as 4-star. So it doesn't have to be necessarily top of the top there. Actually, about half of the apartment inventory in San Antonio would be about 4 and 5 star. So, and that's true for many markets. Actually, in Austin, I think it's like 60%. In Dallas and Houston, it's about 45% of the apartment market's about 4 and 5 star. So, the 4-star level is not maybe as high as you'd imagine. Anyways, we're gonna take a step back there. I got really in the weeds, and we're gonna look at things at the national level. It's much of the same, to be honest with you. The vacancy rate at the national level, kind of a little stubborn for some of these lower rated segments. The 1 and 2 star and 3-star, possibly nationally, eventually eclipsing that 5-star segment in red, but we'll see. We'll see how that goes. Personally, I think that it may not be that way. If you ask me, I think that there has been some movement in reducing vacancies in the 4 and 5 star level, but that may not continue to be the case over the next couple of years. That being said, we're seeing this at the national level as well. So let's look at demand for apartments. Enough of vacancy. Talked a lot about that just now. I want to talk about demand, which in the real estate industry is always measured or almost always measured in terms of absorption. So absorption is what was occupied last quarter and then what's occupied today. So if there were 100 more units occupied today in your local real estate market, that's 100 units of absorption. So that's how we measure demand for the most part in real estate economics. And San Antonio had a pretty rough year there in 2022. It was the first year on record, first calendar year, where it had negative demand for apartments. But that had a lot to do with the run up we saw in 2021 and 2020. And what goes up often does come down, at least for a bit. And you can see that the market has rebounded in a quite healthy way, I think, since 2023 or in 2024. That rising interest rate environment did affect things in mid 2020. But ever since then, we've seen pretty healthy absorption, pretty strong demand. And then moving forward into the future, it looks like demand is probably going to be healthy at about 1,000 units of absorption, pretty much into the end of our forecast there, all the way to 2030, essentially. And that has to do with some strong fundamentals in the market, which I'll talk about later. Population growth, job growth, and wage growth that are supporting this. Texas metros are among some of the top metros in the country for absorption. That has a lot to do with the fact that we've just built a lot here. So what you're looking at on the left there is the top major markets for absorption, and then on the right, the I guess bottom 50 markets for absorption. These are major markets, right? So we're talking big cities here and their suburbs. So when I talk about San Antonio, I'm talking also about New Braunfels and Seguin and Bernie. And when I'm talking about Dallas Fort Worth, I'm talking about those two cities as well as Collin County and places like that. So you can see many markets that look familiar on the left-hand side. A lot of Sunbelt markets have some pretty healthy demand there. A lot of this is a function of how big the market is too. Phoenix there. I know we've got I think Tim on the call from Phoenix, so I wanted to give that place a shout out. It's got 16,000 units of absorption, so that's pretty strong, pretty healthy. Austin, of course, Atlanta, Dallas, Fort Worth. San Antonio is towards the bottom there on the left-hand side. That has to do a lot with the size of the local apartment market. But yeah, I mean, you could see a lot of Sunbelt markets there on the left for absorption, for demand. So that's indicative of the population growth in this region. And then when you control for the size of the market, so you take absorption, basically divided by the total inventory, the existing units there, some of these Sunbelt markets move up a little bit, including San Antonio and Austin, which is at the top there. Phoenix, Orlando, Tampa, also up there as well. So these are many of the high growth markets that we're seeing strong demand for. It's also where we built a lot of product. So if you build a lot of apartments in an area, you also give people a lot of opportunities to absorb those units. So part of it is there's strong demand in these markets, and part of it is that there's also just been a lot of building in these markets. So we also saw a recent wave of deliveries here, and you can see what's to come. It's not much in the San Antonio market, and this is reflective of the Sun Belt more broadly. So now we're zooming back in to South Central Texas specifically, and you're going to see here net deliveries over time. So what's a delivery? A delivery just means a project completion. It essentially just means we're done with construction, we're leasing up these units. The apartment complex has come online. Now, San Antonio experienced quite the wave, as you can see there in 2023 to 2020, end of 2024. And now moving into the future, it's unlikely that we're going to see many deliveries that are anywhere close to that, what we saw over the past 2 or 3 years. That has a lot to do with financing. Honestly, it's the interest rate environment. So long as interest rates remain kind of where they are, and there's a lot of headwinds for multifamily construction for a number of reasons, I would say that it's unlikely that we're going to see this much new competition, these many deliveries in the near term future here. So as you can see, looking forward into our forecast, it may start to approach that 1,000 per quarter we're going to add to the apartment market mark, but it's unlikely to reach that anytime soon. So many markets around the country, not just this one, saw a similar influx of new supply. These are deliveries, completions in a variety of markets, not just San Antonio. You can see, of course, the bigger markets tend to have, more deliveries. That's just a function of how large they are, New York City. But right next to New York City is Dallas Fort Worth in the number two position, and that has a lot to do with the fact that DFW is just a fast-growing metro and it's large. Not quite as large as New York City, nowhere near as large as New York City, but it has almost as many deliveries, or it has had almost as many deliveries over the past 12 months. So that speaks to, I think, the growth in supply in Texas recently. Austin is up there as well, with about 20,000 deliveries over the past year. So that's something. San Antonio at 9,000. So definitely sizable. And I think Houston is also up there, yeah, at 18,000. So I mean, these markets have added a lot of new supply recently, and that explains the dynamic you were seeing earlier with these higher vacancy rates and the situation today. So a lot of this is what's going on currently. It's not necessarily indicative of longer term trends. Now, when you control for the size of the inventory, you can see just how much growth there has been too. I mean, it's just in terms of the total apartment market. I mean, San Antonio added 4% of all apartments that exist at all today were added over the past 12 months. And in Austin, it's 6.2% of all apartments that exist at all in Austin were added over the past 12 months. And that's the case in many Sunbelt markets. You see like 4.6% in Miami, Denver close to 4%, a lot of fast-growing places like Atlanta 3.5%. So that's a lot of apartments to be adding just in the span of 12 months. And that explains the situation right now. It's a pretty temporary situation, to be honest with you, because this supply wave will pass. But it's definitely, I think, something that explains what's happening. And apartment construction starts. So groundbreakings, what we're kicking off in terms of construction, has slowed significantly. I think that all the headwinds I outlined there in terms of interest rates and financing and what's happening for competition, in terms of competition, that explains, why we're just not, kicking off as much construction right now. So what you're looking at there is construction starts over time in San Antonio. You could see that really over the past year, it's been about 1,000 units worth of groundbreakings or less. And then moving into 2026, we don't have a forecast for construction starts, but it's probably going to be pretty low. I would imagine moving into 2027, late 2027 specifically, you're probably going to see what's called what people are calling a supply cliff in the local market. There's just not going to be a lot that's delivered or added to the local market. That's going to probably be true in many markets, because they're all facing the same realities right now. Labor has become more expensive for construction. Construction financing has become more expensive. Interest rates are up, and there's strong competition. So, I mean, 2027 and 2028 are probably going to be pretty low delivery years for a lot of markets in this region, throughout the country, to be honest with you. It's also clear when you examine the local construction pipeline. So this is another way of looking at it, but it's essentially what's under construction over time, what's currently under construction. And you can see right now there's only 4,000 units under construction in the San Antonio market. That is not a lot of construction at all, especially when you consider the fact that it was, at one point close to about 18,000 units under construction. Um, at every market right now is seeing less construction. And we are no longer one of the nation's top construction markets. So, there's just not a ton of apartment development happening here. Nationally, again, it's kind of taken a bit of a back seat as people focus on, other aspects of the multifamily industry. But construction right now has died out. Actually, San Antonio is one of the lower construction markets right now. You can see 3.9 K under construction. That's well below where we typically are. It's really Houston, Austin, and I think, yeah, Dallas Fort Worth are still above average there. Now, when you control for the size of the inventory, things change a little bit, but for the most part, we have seen this slowdown in construction. So some of the markets where we still are seeing a decent amount of construction are Miami, Charlotte, Fort Lauderdale, Nashville, Phoenix, and Austin. But for the most part, every other market has been seeing less year over year. Now let's talk rents. So the average rental rate in San Antonio is now close to about 1250. So you can benchmark that in your mind as maybe what the average asking rent is here. It's pretty low compared to the national average. Texas in general tends to have lower costs of living compared to many markets, and San Antonio in particular does. So you can see that broken out here by segments. So 1 and 2 star, kind of that lower rated segment, 3 star, and then 4 and 5 star, which has a larger gap there. Our base case forecast, like I was saying, is imagining a bit stronger rent growth in that 4 and 5 star segment, with most of that being from the 4 star cohort in particular. And then the 3 star, maybe we'll see it might be treading some water there. I'm not so sure that there's going to be such a large gap, but that's our base case forecast right now. And rent growth has declined, like I was saying, but it is forecasted to rebound. So you look there at where we were in the 2021 to 2023 period. So that really the 2021 to 2022 period, that's when we saw that big run up in rent growth. To today, I mean, it just all the cohorts, all the segments show the same trend. It was this run up in rent growth in that period of time, and then over the past couple years, it's been a bit sluggish, right? This is kind of how markets work, especially when you have this big post-pandemic boom that happened in 2021, 2022. A lot of people got, ahead of themselves probably in the industry, and then things slowed down quite a bit over the past couple of years, thanks in no small part to the rising interest rate environment. But things may change in the future. We are imagining a rebound for rent growth pretty much across the board. So, in the 1 and 2 star segment, which was outperforming, really, that lower rated segment was outperforming past couple of years. It may see lower rent growth in the 4 and 5 star segment. We will see. I think a lot of the assumptions behind that in our forecast are that the 4 and 5 star segment has been seeing pretty strong demand lately. So maybe they could see higher rent growth, but generally there's probably going to be something of a convergence towards longer term trends as the supply pipeline peters out and we get closer to 2028, 2029, and things maybe start getting more normal around here. And this is the last real estate slide I have for you because I got three more after this that are basically just talking about population growth, wage growth, things like that. But this is the national apartment market. So zooming out again, but this is just talking about rent growth. It's much of the same as we're seeing in the Sun Belt. So you see there, it's broken out, actually between 4-star and 5-star there, but kind of in a similar way to the chart I just showed you. A lot of these trends are playing out nationally, so it's not just something that's in the Sun Belt or Texas or San Antonio. Though things are quite exaggerated, I'll say right now in the Sun Belt and San Antonio and markets like this because of just the amount of construction and how the dynamics change things up quite a bit. So moving forward, I think one of the things that's important to keep in mind with any market is demographic momentum, right? I think markets that have strong population growth, strong wage growth, strong job growth tend to have a strong and healthy base, for I guess multifamily fundamentals in the future from a market-wide perspective. So you look here, you could see San Antonio next to its peers in Texas. So this is just job growth now. We're talking non-farm job growth, which is the blue right there. And then this is growth in weekly earnings, it's wage growth basically for private sector workers. That's those yellow dots. And San Antonio is performing above average right now, really right up there for wage growth with Houston and El Paso, and then the strongest in the state as far as job growth is concerned, based on the latest data we have from the BLS, which is always a few months out.
Hey,
So
Danny.
yeah, 1.8%. Yep.
Hey, this is Tim. Can you explain the
Sure.
importance of the blue non-farm job growth?
Yeah, so it's very important obviously for real estate fundamentals, right? But I guess you want me to explain maybe more why it's important for the multifamily market or for like
Sure, both. I'm not that familiar with why farm
yeah.
and non-farm jobs are marked separate.
Yeah, it's just I think it's the way the BLS divides things up. You know, the Bureau of Labor Statistics is the government organization that we all kind of look to give us these big high level stats. And non-farm jobs are for some reason the way things are divided up there. I'm not a labor economist, so I can't tell you exactly why they do that. But usually job growth, whenever someone talks to you about job growth, it's almost always quoted that way. Um, so that's part of it. But and yeah, of course, we're talking metropolitan areas here, so a lot
Okay, I
of
thought they were just maybe trying to
cities
factor out
and
seasonal stuff.
yeah. So this is not seasonally adjusted, but no, I think it's just the data set and how it tends to be produced.
Okay, great.
Just
Thank you.
yeah, it's always quoted that way by the BLS for some reason. I'll have to ask a labor economist. It's a great question. But it's almost always quoted as like non-farm job growth. And yeah, so pretty healthy here. Uh, and what's interesting too is office employment, which is part of this, clearly has been pretty resilient in San Antonio. So most markets lately, especially those that are more exposed to tech and kind of more cyclical industries, as we call them, more interest rate sensitive industries like finance and things like that. So a lot of those markets have struggled lately. San Antonio has a pretty strong finance segment of its local market, but it also has a pretty strong like defense segment and healthcare segment. So that helps kind of insulate it from a lot of the weakness that can occur in the labor markets of a recession or an economic downturn or just sluggishness, right? You don't necessarily have to be in a recession to see job growth slow, but San Antonio is kind of insulated from a lot of that. So that helps. And it's really just San Antonio, McAllen, and to some extent Austin are kind of treading water right now for office jobs. And then we're seeing a little bit less strength in Dallas, Fort Worth, Houston, and especially El Paso right now. Moving forward, population growth is the last slide I got for you guys, so I appreciate you holding on to the end. Looking forward, population growth probably going to continue to be strong in San Antonio. This market, so when I say San Antonio, I'm talking the whole metropolitan area, adds 40 to 50,000 people every year, which is it's a lot of people. As a rate of growth, it tends to be similar to Dallas, Fort Worth, and Houston, a bit behind Austin, but one of the fastest growing MSAs in the country, and that's probably going to continue to be the case moving forward. That's just a lot of people to add to your MSA boundaries every year. We are envisioning that over the future that may slow a bit for a variety of reasons, but so long as you have the fundamental drivers of a city of a metro like this, which has low cost of housing, strong job market, and other things like that, you're probably going to continue to attract people, domestic migration. And that's it. That's what I've got for you guys. Appreciate your time today. Wayne, I'll hand it back to you, and
Yeah.
I'll make the slides available too. If you'll have any questions, I'm also here to take them.
Hey, Danny, real quick before we go to the group for Q&A, can you let people know how they can reach out to you? Because they may watch it on YouTube or listen in a podcast form.
Yeah, absolutely. So my email, I don't have it here on the screen, is D Khalil. So Khalil is my last name at CoStar.com. Feel free to reach out to me if you have any questions. Always love talking about my market, my main market, of course, but also the rest of the state of Texas and other markets I cover. So mostly South and West Texas. And then I cover Central Texas outside of Austin as well. So that includes College Station, and then Waco and Killeen Temple.
I love the slide that there's 40 to 50,000 people going to be moving in every single year because it just goes back to when we look at like the supply. I mean, that supply is going to get eaten, and then you have a development, shortage at some point. So there's going to be some supply and demand issues. Danny, can you also talk about like what San Antonio has going on for it? I know like they drained the Riverwalk a couple weeks ago to get that going, but I mean, there's a lot of revitalization, tourism. Can you talk a little bit about why people love San Antonio from that standpoint? Because that does impact, multifamily as well, quality of life.
Yeah, absolutely. I think there's been a big infrastructure build out here as part of the 2017 to 2022 bond cycle. A lot of the construction projects have kind of been delivered late. But there's been improvements on the Broadway corridor, for example. If you ever drove that stretch of Broadway from like downtown through to Alamo Heights, it's changed quite a bit, especially the portion close to downtown. So there's been a lot of, yeah, infrastructure investments by the city. It's been interesting to see that because I think they invested, $800 million or something like that during that bond cycle into infrastructure largely. It was the most like downtown concentrated bond cycle too. So there was a lot of that happened. Hemisphere was a big redevelopment that saw some money from that. And then the Pearl is a private development that's owned by Silver Ventures, and Kit Goldsberry's team there. So they've actually seen their footprint expand kind of organically, outside of any public investment or something like that. It's been a lot of expansion, I think, from just development, and then just like people who are interested in living in the area outside of that. So that's been interesting to watch. And then on the kind of further out the 1604 corridor, there's just been a lot of residential growth, especially on the far west side. The far west side's kind of where you see a lot of that suburban growth, and then New Braunfels as well, I would say is another key area. But if I had to, tell you, hey, these are the three areas where I'm seeing like a lot of momentum and growth, not just in terms of construction, but rooftop growth. It's Midtown downtown. It's probably New Braunfels, and it's probably the far west side. They've all got a different situation going on, but those are the three areas that just have a lot of momentum, it seems right now. Sorry, I think you're muted, Wayne, actually, if you're.
So sorry. I was reading one of the questions is what is a good estimate for the number of individuals that occupy a multifamily unit? Do you see is it like a one person, two, two and a half? Is any data on that?
Interesting. So, the Census Bureau publishes the American Community Survey every year. They're about to come out with new estimates this week, I think, at a pretty small level, like the census tract level. So you can see that, like these averages. But yeah, a lot of the averages have been going down over time. I don't know exactly what the average um, household is for, a rental unit, like household size, but household size has definitely been going down over time. It's a little bit larger in San Antonio, like slightly than the national average, um, but it's been going down quite a bit. Probably like two-ish, just a little bit below that, maybe.
Yeah. Yeah, it's a great question. One of the things I noticed during COVID was people started getting two, like you're single or like maybe you're a couple, but then you went with a two bedroom, just give you that extra space. But then it's sort of gone back to, let's have some extra spending money instead of get that second bedroom. What
Yeah.
other questions we got? We got still a group left. You can text it or ask questions here. One of the things that, man, I love San Antonio for a lot of reasons, and we're obviously investing in it. Uh, where we're targeting is North Central, and that's sort of the pocket that CREI Partners we're just digging in because there's not a lot of new supply. It's pretty constrained. It's already a built-in, it's already been developed over many of the years. A lot of the growth that you're seeing is West San Antonio. Can you talk a little bit about West San Antonio and just why the growth is happening that way versus some of the other areas?
Yeah, so I mean, for many years, the Northwest side was kind of the premier suburban area, and in many ways, it still is for residential suburban living. If for people that kind of want, that kind of lifestyle, that was kind of where it was. In many ways, kind of like the average of the city and the hub of the city. It was kind of the premier suburban area, and it still is, but a lot of that is kind of moved westward on 1604, which is the outer loop of the city. On Loop 1604, it's kind of moved westward, and now the far west side. So it's not just the northwest side, but kind of the far west to distinguish it from the inner west side has seen a lot of momentum, and it's just really spillover. Essentially, it's a lot of spillover. A lot of people who want good school districts in that area, but also want affordability, and things are kind of new and nice, and it's very car dependent, but a lot of people out there know what they're getting into, and some people like it. So that seems to be a lot of what's driving that area. And the Midtown downtown's being driven by like the urban revitalization trends that are kind of occurring in every market right now, every big city. So that's
Well,
hope
you
that
also start
provides a little
getting,
bit of color
well, you
there.
also, yeah, and that's all good points. You also start getting into like beautiful parts of San Antonio, the hill country and such. So, all right, cool. Questions are coming in. Are you seeing any trend where more people are roommates in two bedroom to save money and that's affecting the occupancy percentages? It's a really great question. Are you seeing people
Yeah.
rooming up to,
Well,
you know,
well, so I will say, I mean, it's a lot of what you're getting at's called household formation. That's kind of I guess, the technical term for it, and it's a good question. I think, you know, uh, household formation tends to increase during, economic boom times, essentially. Like we saw a lot of that in 2021, 2022, and it tends to like go down essentially. You tend to see people increasing their household size during, times when things are uh, not maybe going so well and the job market's not too great and what have you. So a lot of the household formation growth we saw was in that 2021, 2022 period. People split off from roommate situations, moved out of their parents' house, things like that. And then we saw with 2022, which is why I think you saw negative apartment demand that year, a little bit more people kind of consolidating, interest rate shock, things like that. And then I think since then it's been more or less at something of an equilibrium. We're seeing household growth, household formation, but we aren't seeing the levels that we saw 4 years ago or something like that. It's not the same market. People have to feel really confident usually in their job situation, their financial situation to start splitting off and agreeing to pay the entirety of rent on their own. Um, that doesn't quite answer the question directly because I don't have the statistics right in front of me. But essentially, what you're getting at there is household formation. And I think if you email me after this, I could probably look up some stats on that. We can have a conversation.
yeah. Well, I can tell you on our portfolio, we are seeing it where people are there's a lot of uncertainty, and so people are, becoming roommates and such, and moving back home, mom and dad. So just something we have to work through as well. While you, one question, I don't know if you'll have this, Danny, but maybe something Rich, you follow up afterwards. But while you showed the percentages on office jobs and also wage growth for San Antonio and major Texas cities, can you provide what those actual job growth and or office job growth and average wage numbers for a better comparison? So I don't know if you'll have that data on this, but
So I don't. The question is about
so
office wage
actual,
growth
yeah,
or
actual
the.
office job growth and average wage numbers for a better comparison.
Well, so I mean, generally the sectors where we've seen significant wage growth over the past year. It's been healthcare, and it's been to some extent hospitality. Um, some of these kind of more cyclically resilient industries. Um, Office has not seen as strong of wage gains, I think, generally speaking. Most of these stats, by the way, at the metro level are published. They don't break them down by industry. I would have to like pull some national data and look at it that way, but I'll tell you, as far as wage growth is concerned, a lot of the wage growth leading industries nationally have been the non-office segment. It's been a lot of healthcare, social assistance, that bucket, and then also probably leisure and hospitality too. Surprisingly enough, which is a very cyclical industry, but there has been some notable growth there. But other than that, it's largely healthcare that's kind of doing the major heavy lifting right now.
Well, Danny, we'll leave it on that for this recording. For those that are on in this meeting being recorded live, I'm going to stop recording and then maybe give a few more minutes for questions. But Danny, thank you so much for joining and giving us, a lot of this information, especially early on in the year as we look to invest in Texas. I think not only San Antonio markets, but elsewhere. So, Danny, thank you again for your time.
Yep, happy to be here. Thanks for inviting me.